income was $179 million, better than what our plan was, and $148 million better than the prior year. Some of the key drivers for that was operating revenue was up, primarily due to weather, while our fuel expense was actually down, and that was because of somewhat driven by the performance of our fleet. We had better availability of our nuclear fleet, so low-cost clean generation there, as well as our hydro fleet with better, more rainfall than we had anticipated in the plan, and also lower natural gas prices. Natural gas prices are almost $1 cheaper than they were a year ago. And so our operations and maintenance expenses were favorable as well, so we're ahead of the plan to achieve the $500 million reduction for this year so far. The cost reduction initiatives combined with some timing associated with some of our outage projects that will move into the spring. And then lastly, interest expense was favorable as well because of a refinancing that we did last year at a lower rate than anticipated. And so the income statement, I reviewed the highlights of the numbers, but there's a few things that I would like to point out. One is overall revenue was $2.4 billion for the quarter. When we focus on our O&M expenditures, and I'll highlight more of this on the next slide, is we really break that into one element, which is what we call our business unit spending, which is the real direct operational spending. And then the other O&M expenditures, which is sometimes be heavily influenced by accounting practices or actuarial changes that we don't think necessarily reflect pure operational performance, and we'll talk about the results that way. The $500 million is real operational sustainable performance, not driven by other accounting mechanisms. And you can see overall that our net income was $81 million for the quarter. And so it's somewhat rare for TVA to actually have a positive net income in the first quarter. As you can see from the plan, we typically expect, because of the low energy uses in the shoulder months, that we would operate at a loss for that quarter. And so that was overall very good as well. And so just to speak to a bit about the O&M and the $500 million, this chart shows the beginning point of our $500 million challenge, which was our 2013 budget. And our overall planned expenditures in that year were $3.7 billion. If you notice that the line on the chart begins at the business unit planned expenditures, and $500 million, as I said, is calculated from that. We would expect our overall operations and maintenance expenditures to be at $3 billion this year. And so you can see in aggregate that's a $3.7 billion reduction, but $200 million of that is driven by a change in pension accounting. So we don't count that as real operational performance, so we exclude that from the calculation. So it's the $500 million real sustainable O&M. I just wanted to spend a minute to clarify that and make sure that it was clear to the board how we were focused on real sustainable results. So then to spend a minute on the operating cash flow. And so $473 million of operating cash flow. That was slightly behind what our budget was, but that was purely driven by timing issues associated with the fact that we had higher accrued expenditures in the last month of the fiscal year of 2014 that we paid the cash out for 2015. But overall, this year we've had planned capital expenditures of $3.5 billion, so the largest capital spending plan in TVA's history. And you can see that we spent $1 billion of that, and those projects are essentially, most of them are on plan for the year. And we'll continue to update the board as we go forward on those items. We did do $524 million worth of financing in the quarter net, and so that shows up in the financing section. Lastly, I'll note that our overall debt level is $181 million lower than what our plan is. And at $26.5 billion, we've reduced our overall debt by $1 billion over the last 2 years. And then our statutory debt that counts towards our debt ceiling is at $24.1 billion. And so in summary, we had higher revenue, lower fuel costs, lower operating costs, resulted in higher net income and lower debt than